investment instruments and your path to financial freedom. Hello investment enthusiast, welcome to another exciting episode of Road to Financial Freedom. Today, we're delving deep into the intricate world of investment instruments and strategies. We'll discuss the pros and cons of different investment options, from traditional real estate investing and the stability of bonds in this video to the more modern volatile investment of stocks, index funds and the potential for explosive growth in cryptocurrencies on our next video. Whether you're a seasoned pro or just starting your investment journey, this video is packed with valuable insights that you won't want to miss. Before we dive into this knowledge-packed episode, make sure to hit that like button, share this video with your fellow investors, and subscribe to our channel for more in-depth financial education. The more you engage, the more we can bring you valuable content. Let's explore some traditional investment options that have stood the test of time. Real estate investments. Real estate investment is the act of buying and holding real property for the purpose of generating income or appreciation. There are many different ways to invest in real estate, but some of the most common methods include buying rental properties and flipping properties. The power of compounding in real estate investing comes from the ability to reinvest the profits from one property into another property. This process can be repeated over and over again, resulting in a snowball effect that can grow your wealth exponentially over time. You can then use this money to buy another rental property, or you can use it to improve the property you already own. If you continue to reinvest the profits from your rental properties, your wealth will grow faster and faster over time. In addition to reinvesting your rental income, you can also use the power of compounding by financing your real estate investments with good debt. Good debt is debt that has a low interest rate and a long repayment period. This type of debt can actually help you grow your wealth by allowing you to invest more money in real estate. If you invest the money you would have spent on a down payment in another rental property, you will generate enough rental income to cover the mortgage payments. In this case, the mortgage is actually helping you grow your wealth because it is allowing you to invest more money in real estate. Imagine you purchase a rental property for $200,000, and you put down a 20% down payment of $40,000. You finance the remaining $160,000 with a 30-year mortgage at fixed interest rate of 4.5%. Let's say your rental property generates $1,500 in monthly rent, which is $18,000 annually. Your mortgage payment, including principal and interest, might be around $811 per month or $9,732 annually. After deducting operating expenses, property taxes, insurance, maintenance, etc., from your rental income and subtracting the mortgage payment, you might have a positive cash flow of $3,000 annually. Now, here's where compounding comes into play. Historically, real estate tends to appreciate in value over time. Let's assume your property appreciates at a conservative rate of 3% per year. After the first year, your property is now worth $206,000. As you make mortgage payments, your equity in property grows. Instead of spending your positive cash flow, you reinvest it in the property or use it to purchase additional rental properties. After 10 years, your property is worth approximately $267,171, and your equity in it is about $60,219, and so on. Of course, there are risks associated with real estate investing, just like any other investment. However, if you do your research and manage your risks carefully, real estate can be a very rewarding way to grow your wealth. This is just a simple example illustrates how compounding works in real estate investing and can potentially bring passive income. Over time, not only does the property's value increase, but your equity also grows, and the positive cash flow can be reinvested to acquire more properties. Here are some additional tips for using the power of compounding in real estate investing. Start early. The sooner you start investing, the more time your money has to grow. Invest for the long term. Don't expect to get rich quick in real estate. It takes time and patience to build wealth through real estate investing. Reinvest your profits. This is key to compounding. The more you reinvest, the faster your wealth will grow. Use good debt. Financing your real estate investments with good debt can help you grow your wealth faster. Diversify your portfolio. Don't put all your eggs in one basket. Spread your risk by investing in different types of real estate. Bonds. A bond is a loan that you make to a company or government. In return, The borrower agrees to pay you interest over a set period of time, and then repay the principal amount at the end of the loan term. Bond investing can be a good way to earn a steady income and reduce your risk. Bonds are generally considered to be less risky than stocks, and they offer a predictable stream of income in the form of interest payments. Relatively low risk. Bonds are generally considered to be less risky than stocks, especially when investing in high-quality bonds issued by governments or large corporations. Income. Bonds typically pay interest payments, which can provide a steady stream of income for investors. Maturity dates. Bonds have a maturity date, which is the date when the principal amount is repaid to the investor. This can provide investors with a sense of certainty about when they will receive their money back. Liquidity. Bonds are generally considered to be liquid investments, which means that they can be easily bought and sold. Here are some of the cons of bond investing. Interest rate risk. When interest rates rise, the value of existing bonds typically falls. This is because investors are willing to pay less for a bond that pays a lower interest rate. Inflation risk. Inflation can erode the purchasing power of the interest payments you receive from bonds. This is because inflation causes prices to rise, so the amount of money you can buy with your interest payments decreases over time. Credit risk. The borrower may default on their obligation to repay the bond. This is more likely to happen with bonds issued by lower quality borrowers. Liquidity risk. In some cases, it may be difficult to sell bonds quickly at a good price. This is especially true for bonds that are not well known or that are not actively traded. Overall, bond investing can be a good way to earn a steady income and reduce your risk. However, it is important to understand the risks involved before you invest in bonds. Here are some additional tips for bond investing. Invest for the long term. Bonds are typically considered to be a long-term investment. This is because the interest payments you receive from bonds are typically reinvested to grow your money over time. Diversify your portfolio. Don't put all your eggs in one basket. Spread your risk by investing in different types of bonds, such as government bonds, corporate bonds, and municipal bonds. Rebalance your portfolio regularly. As your financial situation changes, you may need to rebalance your portfolio to ensure that it still meets your investment goals. Consider working with a financial advisor. A financial advisor can help you develop an investment plan that meets your individual needs and goals. Thank you so much for joining me on this journey into the world of real estate investing, the incredible power of compounding for wealth building, the strategic use of good debt, and the often overlooked world of bond investments. As you embark on your journey toward financial success, remember that education and continuous learning are your most valuable assets. I hope you found this video informative and inspiring. If you enjoyed this video and found it helpful, please give it a thumbs up, subscribe to our channel, and write more in the comment below for more valuable content on finance, investing, and wealth building strategies. Thank you for watching, and see you in the next video. Until then, happy investing.